Here's what most people get wrong about retirement. They spend decades saving, but when it's finally time to spend that money, they either freeze or they spend too fast and end up stressed out later because there was no strategy. Hi, I'm Eric Rodriguez, certified financial planner and founder of Wealth Builders LLC. And today I'm going to be showing you exactly how to plan your retirement spending using the go-go, slow-go, and no-go phases of life. We're going to be walking you through how much you can safely spend during each stage, where to pull it from, and how to protect your lifestyle from poor cash management and inflation. Oh, by the way, I recorded a separate video that walks you through a very prescriptive cash management strategy to help you structure your retirement spending accounts. I'll link that in the show notes below. But what we're going to talk about today is the issue that a lot of pre-retirees and retirees have when it comes to how to sustain a retirement plan, a spending strategy, etc. So the problem is most retirement plans, they act like you're going to spend the same way at age 60, 70, 80 years old plus. But life doesn't work like that. At 60, you're active potentially, you're traveling, you're doing hobbies, you're making memories, right? If you're able to. At age 75 and a little bit older, life starts to slow down a bit. You're doing less adventures, maybe at more home comforts. You're spending time with grandkids, and maybe you're thinking a lot more about healthcare. And at 80, 85 plus, it's all about your essentials, your dignity and care, your security, estate planning, things like that. So if you don't plan on these shifts, here's what you potentially could risk. First off, underspending in your best years. Next is overspending early and feeling trapped later. Maybe even overpaying in taxes potentially. And here's the kicker, being too conservative and letting inflation quietly erode your wealth. So how do you plan this right? Well, step one is you have to know your phases. So the go-go years, that's ages 60 to 75. These are your active years, higher spending on travel, hobbies, family fun. Then you have the slow-go years, that's age 75 to 85. This is when potentially life starts slowing down again and it's more comfort spending. You might have some rising medical costs. And then you have the no-go years, right? When you're 85 years old plus, where now you're basically spending money on essentials and majority is healthcare dominant. Step two, you have to calculate your safe spending. So here's a simple formula. You can take your annual spending, so that's going to equal your portfolio value times your withdrawal rate. So your go-go years, roughly 4 to 5%. So on $2 million, that's $80,000 to $100,000 per year. 4 to 5% is a pretty common withdrawal rate. Then you have the slow-go years, right? Where you're probably looking at 3 to 3.5% withdrawal rate. So that's $60K, maybe $70K a year. And then you have the no-go years. So that's even a lower withdrawal rate. That's 2.5%. Maybe 3% at roughly $50,000 per year. So the next thing you want to do is you want to watch inflation. Inflation is the silent killer of retirement plans. Even at 3% inflation, your cost could double in about 24 years. So a $100 dinner at age 60 could cost $200 when you're late 80s. I know, it just blows my mind every time I talk about that. But if your portfolio is too conservative, you have too much cash, too many bonds, too many money markets, you risk falling behind just when you need your money the most. So that's why your plan needs to have enough growth, enough equities to protect your purchasing power while still managing risk as you age. Step four is you want to pull from the right accounts. So everyone's different, but a very common order that you could implement potentially for your situation is first, you're going to start withdrawing from your taxable brokerage accounts first or your bank accounts. That's going to help you reduce future capital gains. Next, we're going to want to do Roth conversions potentially from an IRA. If you're 59 and a half and maybe pushing 60 and you have roughly $2 million saved as an example, maybe up to that 24% tax bracket is what you want to do the conversions to, because later on in life, that's going to lower your future required minimum distributions. The third thing is your IRAs, once required minimum distributions kick in, you're going to want to pull from those roughly at age 73. And then Roth IRAs will be last. So let that tax-free money grow as long as possible. So what does this do? This sequence helps lower your lifetime taxes. It protects your Medicare premiums and creates a smoother cash flow process. Step 5 is you want to build a real spending timeline. So spend on purpose in the go-go years, travels, hobbies, big life goals, etc. Adjust as you slow down. You know, if you find yourself not wanting to travel anymore, or if you're just not spending as much, then you can adjust for that in the no-go years. But you also want to have structured cash reserves too. You want to be intentional about that because, you know, once again, when you look at the cash management video, I'll walk you through how to structure that. But you want to have emergency reserves, and you want to have a strategy having more expenses than you do investments and other assets you can pull from. So I wanted to walk you through a quick case study briefly. We're going to walk through a client. We're going to change their names. We're going to call them Dan and Maria. So this is where they are versus what they need. So give you some background on Dan and Maria. So Dan and Maria are both 59 and a half. They have $2.1 million saved. $1.3 million is in an IRA or 2 IRAs. $500,000 is in a taxable brokerage account, and then $300,000 is in their Roth account. Dan also gets a pension of $1,500 a month as soon as he turns 60. Their current plan is they're just gonna start pulling from their IRAs at age 60. They're gonna claim Social Security at 62 just to be safe because they are not bullish on Social Security. And then they have a portfolio that is 60% in bonds because they're scared of market volatility. They have no plan for taxes, inflation, or any variables that happen in the various spending phases. So here's what they actually need. So during the go-go years, so between the ages of 60 and 75, they're gonna need roughly $120,000 a year for spending. They're gonna use this to travel, for their basic living expenses, to buy an RV, they wanna give family gifts. So what we're gonna do is we're gonna pull $60,000 a year from their taxable account. Then what we're gonna do is we're gonna do a conversion. We're gonna do roughly about $40,000 a year up to their 24% bracket, as I mentioned earlier, because they have roughly about $2 million saved. And that is a really good place for them to cap out their ordinary income taxes during their retirement years. Then what we're gonna have them do, we're gonna have them delay Social Security to age 70, higher lifetime and survivor benefit by doing that. What we're also gonna do is we're gonna reposition their portfolio. So we're gonna do the opposite. We're gonna do 60 to maybe 65% into equities, stocks, etc., globally diversified funds, so they have enough growth to outpace inflation. So we wanna flip that maybe 60-40 portfolio, at least on the onset. Now, when we go to the slow go years, right, from 75 to 85, they're roughly gonna need about $90,000 a year for spending as their lifestyle naturally slows down. So Social Security and pensions are gonna cover about 70% of the needs. So we'll have to fill that gap with a combination of pulling from IRAs, and that's gonna happen organically because we'll have the required minimum distribution. So that's what's gonna help us fill that gap. Now, in the no-go years, so when they're 85 plus, we're gonna have, they're gonna need roughly around $70,000 a year focused on their healthcare and essentials. So what's more common here is what we're gonna recommend to them is they're gonna have Social Security and the pension cover most of it. Then their portfolio, and if need be, their home equity reserve will be available for long-term care. So depending on what transpires, we may have them pull a home equity line of credit just to have for emergencies so we don't have to touch their portfolio. We may even do some securities-backed lending if that makes sense for them during that time. So here's the result though. So now with a structured plan during the different phases, they can now say yes to the life they want now without risking their future security or letting inflation quietly ruin their plan. They have more flexibility, they have clarity, and this is something that they will want to adjust, you know, as their lifestyle changes as well. So this is something that you can do. This is an exercise you can do. You can potentially go through your different phases for you and your situation. If you have a partner, you can talk about how you would like to spend the go-go years. Maybe you're gonna spend more than you think. Maybe you'll spend less than what you think, but just having that basic understanding of what that looks like for you can really, really help set you up for a really secure and happy retirement. So if this is helpful, please like and subscribe, share it with someone who's potentially thinking about retirement. Like, at the end of the day, you worked hard for your wealth. Now let's make sure it works for you. So feel free to look at the show notes, take a look at the other videos, and I'll see you on the next one. Once again, it's Eric Rodriguez here. If you're looking to get help securing your financial future and you're serious about implementing a wealth plan for your specific situation, feel free to check out my website, wealthbllc.com, to learn more about how I work with clients, how I help them align their resources with their values, and put together a comprehensive plan to help them retire on their terms.